and thank you for coming. We'll get started once Melissa pulls the slideshow up. And here she goes. So we'll just run through it real fast. Welcome to Town Hall 18. You know these two ugly mugs. My name's John Best. I'm the CEO and co-founder of Best Innovation Group. I'm also currently the COO, CTO, and like 9 other things for Beyond Imagination. So really cool stuff going on with the robotics. I'm actually going to invite Harry to talk a little bit about that because it has an effect on
Oh, wow.
on COVID. So we'll get him on the show. And Mr. Lawson, who
Yes,
Mike,
sir.
you're gonna be first up a little bit because I want to talk a little bit about the economic. Your meeting with CUNA's economist, and I want to go over a
Oh,
little bit.
yeah. Well, that was
Just
actually on like a CUNA media call. So I have the notes from that. But yeah, that was some pretty
yeah,
interesting stuff they
yeah.
said.
We went. I reviewed it. It was very good. So we'll talk about that a little bit and
Good.
go on to the next one. Here are all the rules. Oh, and this homeless person, as you can see, we found roaming around, and it goes with today's topic. So I'll get to that in just a bit. So Mr. Ben Morales, we're thankful to have him. The format, short briefing from me. Let Melissa know if you'd like to talk. I see people are already popping into the chat, but please let us know that you're here. Anybody that doesn't let us know that they're here will boot because we don't want any weirdo Zoom bombing. My biggest fear is Sarber, but it looks like he's wearing clothes today, so that's all good. For those of you that don't know, Kevin Sarber is our president here at BIG, and my continuous panel of Jonathan Silly and Tom O'Shea from Aspire here, my esteemed panelists, which is always awesome. If there's something that you think a broader audience should see, please pop it into the chat. Oh, and Gary, this is such a great group we pull together every week. If there's a sense that something needs to be bigger, Mike will take that on. And we actually ran into this just recently. We talked about it in the last show. If we are recording and publishing these, and Unite has pointed out that some of the talk we had about fraud, but might be, since these are public, informing the fraudsters. So we have removed all that, and we will audit any of this. But if there is something that you speak to that you want to edit it out, you just let Melissa know or email me, and we'll take care of it. So we already went through and removed all of that. So with that in mind, welcome. We'll get going here. So next slide, chat, just so you know how to do it. I think, like I said, when we first started this, we had a lot of Zoom neophytes. Now everybody's a Zoom expert. They're all changing their backgrounds and dancing and turning themselves into potatoes and all kinds of weird stuff. So no longer do I need to explain Zoom, but just in case, that's where it's at. Let's move on to the next one. So start off with Mike. So Mike, you had an interesting meeting with the economists. You were on the media call with the economist for CUNA. I want to talk about that just a little bit, and it kind of leads into this.
Yeah, I thought it was really interesting that he kind of ended up it was only a minute long, basically. Every Monday morning, CUNA has a media call where all the folks in the media go on this one call, and then CUNA has their subject matter experts come on and talk about their topic of choice. And obviously the economy is very interesting to everybody right now. And I thought that was really interesting that Mike Schenck, who is the chief economist there at CUNA, he ended up actually saying that expectations for unemployment were a bit rosier than they had previously talked about, probably a couple of months ago. So I thought that was a really interesting way for him to end it up. But he talked about, I have my notes right here. This is why I'm looking at it, because I haven't looked at the interview or the story since Monday morning. But said savings is actually up 14% year over year. Let's see here. What else did he say? Loan to share rate is down. This is the biggest. It's down. Biggest rate in 30 years. Asset quantity. Delinquency rule. Oh, gosh, I can't even read my notes. I apologize. But I thought, yeah, it was loans were up, and then I apologize. I should probably
loans
have
were up, delinquencies were down, and he was predicting a fairly positive future.
Yeah, it was actually a glasses half full type of economic outlook, which really took me aback a little bit, because you hear quite the contrary in the mainstream media. So having CUNA's chief economist say that, and I follow a number of other chief economists or economists throughout as well, and they're all kind of echoing what he said. So it seems to be there's some good news on the horizon. And it seems the numbers that they were predicting in the beginning are much, much lower now. So I think that's overall, I think it was really a good news stint that he had. But yeah, just go to cbroadcast.com and the story's right there on the front page. And it's only 1 minute and 16 seconds. So it's a quick little watch from his
Yeah,
thing.
it was just a quick, but it was really good. And as always, you edited it very well.
Thank
But
you.
my, what caught my ear about it was I was questioning this. We've talked about this quite a bit, but I started doing some research on it. And my concern is that the rosy outlook is based on data that I worry isn't real. So, for example, think about, and Jonathan, Tom, Gary, a lot of people on the call, we've talked about this. How many deferments on loans have we given? I remember Gary giving us some notes that was a record. Go ahead, Tom.
Yeah, I mean, this is the thing. You think about it, we've done thousands, even in our smaller credit union, 28,000 members, we've done thousands of deferments. And so effectively what we did was, as of March 31st, we froze your delinquency. You would not get any worse than where you were on that date, which could be 30 days, 60 days, 90 days, whatever it happens to be. You froze there. However, people did continue paying, and when some of those checks came in, there were payments on some of those delinquent accounts. So that was going to push the actual reportable delinquency down, because nobody got worse, but people did get better.
Right.
After 2 months or 4 months after we come out of this, all the chickens are going to come home to roost, and we're going to now see, who is still not working, or who's at reduced employment, whose spouse isn't working. So I think the credit score numbers are a big concern, and the credit reporting, what that's going to look like, the delinquency numbers, and I think there's going to be some of that's going to explode. That's going to blow up on us in the second half of the year, as we start getting back to normal.
I heard someone else chiming in. Was it Mike?
Yeah, it was me. I was agreeing with Tom. I think right now is not the time. I think probably early fall is going to be where the stuff hits the fan pretty much. So, and when all the delinquencies, all the collections start coming in, the next 90 to 180 days, something like that. So yeah, it's going to be really interesting this fall and winter.
Well, yeah, I was going to say, John, with that, we did 3-month deferments for our members when they requested them. So roughly most of them are starting to come in beginning of March and April. So I would say by July or August, we're going to see a major round of hardship potentially cycling through the collections and lending part of the organization here.
That's exactly what, Kevin, you want to chime in? That's what you and I have been talking about. Go ahead, Kevin.
Yeah, I think you've got that. I think you've got in particular the unemployment benefit expansion, or the bonus unemployment that that has helped the people stay current, along with the deferrals. But if they're not going back to work, or if they're going back partial, like Tom was saying, I think it's going to be in that August, September, October timeframe that we may start to see some of that starting to fall out.
Well, and Kevin, when I happened to experience the 2008, 2007, the whole thing, that fallout with a lot of you. Ben and I were partners, even through that, and Kevin and I experienced it in the same institution. And things have changed quite a bit. So if you look at this second line here, and I'll annotate it real fast, but I was doing some research on what's likely to be an issue. And this paragraph here comes from a report, according to the New York Federal Reserve, that we have more car loans now than we have ever had. It eclipses mortgages by far. And some of it was related to, to get out of debt, buy a car, 0% loans when things hit. That was a big thing. But, there are, far more car loan accounts than mortgages. So what does that mean for us? Well, what I've found in the past is most of us are made up of a lot of car loans, and a lot less mortgages. Now, Tom, from your perspective, that may be different, because you're in a more urban area. But the trend seems to hold. And so those are particularly of issue because the worry is that they'll be the first things that people abandon because they're working from home now, or they don't need it, or they're going down to one car. Look at Hertz. Hertz has been in business a zillion years, and now filed for bankruptcy, reorganizing. And one of the dependable things they always had was selling the rental cars that they had. I wouldn't want to buy one after Ben gets done with it, but if you've ridden around with Ben at a conference, you'd know what I'm talking about here. But at the end of the day, I do think that this rosy view, I feel like all of us are sitting on a whole bunch of hand grenades that we pulled the pin on. And now it's just a matter of when they go off. The question is, how do you get ahead of it? How do you determine, right? Gary, I was going to throw this at you, but one of the things that I was thinking of is some reporting and some machine learning, which we've agreed to have another data meeting, which we'll be pulling together, but some machine learning to try to anticipate based on the deferments and some of the other data that's new to us, who may have an issue. Because I think that's really the name of the game, is what we found at Westcom, Kevin, I believe, was whoever got to the door first and said, I want my money, everybody wants to pay. It was a matter of where you were in line, right?
Absolutely.
And so somehow getting ahead of this and getting these folks and finding a reason to call them, back to my, the drum I beat all the time, which is that direct deposit stopping. That's a great reason to make that call. There's got to be some more canaries in the coal mine that we can discover. But where that led me was, okay, what do people do when they start to get desperate? What's the first thing they do? Well, in looking out there, and I, was Ben and I stay in pretty good touch, I think, over the years, probably at least once a month, if not more. And one of the things that we were starting to see is a lot of warnings, and these are all recent, like the Wall Street Journal is from 4 days ago, How Payday Lenders Target Consumers Hurt by Coronavirus. It's a great read. That's a Wall Street Journal piece. So they're figuring out how to find these people. And I know we're going to see a huge surge in this. And what does that mean for our members, and what does that mean for us? And so one of the things I wanted to just talk about a little bit was, and the reason I want to talk about this, because we're going to lead into Ben, but I also want to get some feedback from Jonathan, who I know is a client, and Tom and the rest of the group. But Kevin, I want to say it was like 2004 or 5 when Westcom acquired a payday lending company. Was that right?
Yep. It was a learning experience for us.
But it was great intentions. I think it was a valuable proposition that we were trying to do.
Yes. We were actually looking at it as a potential way to attract new members, and put together a number of different, packages over the period that we had the company active to try and attract those folks to come in, look at an alternative lending product that was better than the payday loans, and come into the credit union. And what we found was, at that time, that those folks were very comfortable with where they were used to it, they understood it. They didn't really understand credit unions, so it was a bit of a challenge in educating them and getting them to come in more than what we had anticipated before we did it.
Yeah, and so that was one step, right? And I remember specifically working on ACH to Mexico, because as I remember, these poor people were coming, and not only were they cashing their paycheck and losing money there, but then they were losing more money because they would ship it home to Mexico via Western Union or something like that. And it was, at the end of the day, it was like a $400 paycheck that these guys were sending $100 home and losing $75 to $100 on the transaction,
Yep.
Which is robbery. It's predatory. I mean, it's exactly what it is. So a couple things, just thinking out loud. One, before we get to Ben. So one was, how do we find people in our system who are doing payday loans? Like, do they put the money into our account? Are they getting cash? So Jonathan, you're nodding your head. You got an idea?
So I was just going to say that again, full disclosure, we're a QCash client, but and we're a very happy QCash client. I'll add that there.
Hey Ben, nice score one for Ben.
But and actually, I was just going through and pulling up my our what we call our personal assistance loans. That's the way we've branded them with QCash, we actively had our business intelligence group go out and look for transactions coming through known payday lenders in our field of membership, to try and reach out and do some outreach to members that we knew, we're really getting taken to the cleaners by some of these payday lenders when we had a potential alternative to their current solution for getting cash. And just as an example, we have over 12,000 loans on the books, or that we've completed through the QCash platform since we launched the program last year. So it's been, I think, for our membership, it's an incredible product for them. It's much better financially for them than anything they can get from a payday lender. And for us, honestly, as it's allowed us to serve the underserved community, but and it's also been an eye-opening experience, because you start to see people that use these loans that maybe you weren't in demographics using the loans that you didn't really think about. They weren't really the target audience for this, and it sort of opened our eyes to some of the financial hardship that our members experience in demographic groups that we hadn't really thought about before. So it's been incredibly successful for us, and I think very popular with our membership, and especially those that need to get a affordable loan, small, we go up to $1,000 with our loans, they just need an affordable source of a loan that doesn't, like you said, take 30-40% of the money off the top because of the interest and all the fees and everything else, John. So yeah, it when we installed that program or put this program in place, it was an eye-opening experience about who used it, why they used it, and just the need in our community.
So 2 questions, follow-up questions, and I could see Mike, he's thinking the same thing too. I saw him write a note. The first one is, so you have that data. I wonder if you tried to correlate that data with folks who were getting the unemployment, what that would look like. And then the follow-up question is, have you seen a rise in the use of the service, in the last 3 months?
We absolutely have seen a rise in the use of the service over the last 3 months. I think, and primarily because we've positioned this product as a solution for members who are experiencing financial hardship due to job situations, reduced hours, that sort of thing, as a potential way to help them. And we haven't specifically done this to correlate it to unemployment benefits, but we did, and I'm actually thinking that's going to end up coming pretty soon. What we did, though, is we broke down our data by generational groups, because originally when we went through and did this, we were really curious about who was, what source of individuals were taking these loans. And, it's interesting. We, the sort of Gen Y millennials are our biggest group. But Gen X is not all that far behind. And, interestingly, baby boomers are the, third in line for us, followed by Gen Z. And then in the distant sort of, back are the, what we categorize as our traditionalists. So this is what started to open up our eyes to the demographics. We didn't really peg the Gen X generation as a heavy user of these loans. They're in the prime of their earning years, and as well as some of the older millennials. Yet those two groups are the heaviest users of these loans, and that really sort of changed our perception a little bit about who needs these loans and why they need the loans.
Yeah, and so perfect, and I would expect that demographic to shift to more of the folks who were likely to have those jobs that have been deprecated.
Absolutely.
But coming back around, so
Hey, John, before you leave that thought,
oh no, please go
there's
ahead.
one on kind of on your screen that ties two things together, but that there's a coming issue that I haven't heard a lot of people talking about, and that's the fact that our tax payments were deferred from April 15 to July 15.
Yeah.
And I think that's a coming both danger and opportunity for loans in that space, because I think deferring it was great, but when that starts to hit and your unemployment starts to the boost there goes away, that could be an issue and an opportunity.
Absolutely. And so there's all these different contributing factors, and clearly I guarantee you somewhere Gary is furiously writing because he's going, I'll have that by next week, right, Gary? Am I wrong? I guarantee you he's not in his beat anymore. Yeah.
Yeah. So we've run that unemployment report, and we've cross-referenced it with the loans that those members have with us. And about half of the members that are currently receiving unemployment benefits have loans with us.
Wow.
So what we've done instead of the QCash is we have an emergency loan, and the first, I think it's 90 days, payments are waived. And we've done some of those. I don't have the exact number, but we have done some of those.
Did you cross-reference that? I wonder if you have the data to do what Jonathan just said, which was, to be able to find out like who's getting a deposit from these payday loan guys, right, Jonathan? Isn't that what you did? So that you could
So what we did is we looked for transactional data, and we looked for fees too, but we specifically looked for the deposits coming in from payday loan vendors, and that we looked for in our area. We had our marketing team do some research of all the payday lenders in our area, and then we had our business intelligence group pull all that data into our in-house data warehouse and analytics platform, and then produce sort of a list and reports of everybody that's using payday lending in our area that might be a good fit for, in our situation, QCash loans, but our emergency loans or anything like that.
Yeah. So Gary, that's where I think there's a tie-in as well.
Yeah, we have our top merchants report that looks at our members of the checking accounts and where they're sending their money each month. I've looked at that for payday lenders in the past. I don't know what the number is now, but it's time to revisit that. So
and I wonder about the early indicator on that's going to be the incoming, not the outgoing.
Right.
So
right.
just thinking out loud. But so let me tie all this together. Let me just, Ben's been patient, and I want to give him the last half hour of this, but I want to tie it all together in a way that kind of makes sense. So as Kevin pointed out, Kevin, you pointed out the exact thing I was trying to do, that we do taxes and the payday loans, but this is a physical place. And one thing these guys are not great at right now is digital, because they've always sort of expected these dudes to show up. It's part of how they do their business. It's how they do it. What Ben has created is the digital model of this. However, let's look down here. So loan outfits bypass ad bans by Google and Facebook to get around state restrictions on high interest financing. So our members are being heavily solicited. And right now, if they're in that desperate mode, they're likely to click on something like this. So where I'm bringing this all together is I have met with a lot of CEOs. I've talked to a lot of people, and what I think the strategy is right now for digital is not, in general for the business, but is not to put on the brakes. It's full speed ahead. It's almost like someone has finally allowed us to land the plane. You know, we've never been allowed to land the plane. We've always had to work on it in flight, but in a way it's kind of landed a little bit, and or we're at least down low enough that if we fall out of it, we won't die. And we've got this opportunity to really attach a lot more digital products because people are looking for them. And so what I was thinking is, if you know that there is a trend coming, that people are going to need money, and that, so we know that for sure. We've concluded that based on, Tom's information, Jonathan's information, Gary's information. We all conclude that, Mike Lawson, 100% wrong. Whatever he was saying was not even true. Just making up stuff. Fake Mike Lawson, fake CU broadcast. Just kidding. I don't know, Mike. But if we all believe that, then we can almost guarantee that our membership is going to have a need for payday lending. So why not have something in place that can do that? And also, the other part of it is there's a lot of complex law around it. We don't want to be these guys, that you have to figure out. And Ben is an expert in all of that. So I've asked Ben to come speak to us, and I would encourage everybody to kind of talk. Before I go, I just want to switch back to Tom. Tom, you still there?
Yeah, I'm here.
Yeah. So Tom, I would think in your neck of the woods that payday lending would be a real problem.
Well, actually up here, it's not too bad because so many restrictions. Like in New Jersey, most of the payday lenders are closed. Were put out of business last year by some of the state laws. It hasn't been an issue. So the concern is that because credit unions, and I know Ben's going to hopefully counter a lot of my concerns or points in his presentation.
This is why I wanted to get you going.
You really can't price a loan to where the risk is. What payday lenders are charging is absolutely outrageous. But when I'm limited to 18, 21%, I can't afford the risk of some of the higher risk borrowers that are out there. If I can go into the follow the bank, get it closer to 30%, I could suffer a 10% loss because I'm earning more. And of course, we've got to be able to make the loan affordably. You have the PALS programs, but there's restrictions and limitations, and it becomes more expensive to manage it. One thing that we do for our members is we pay them generally 2 days before payday. So when we get the ACH file, we post their pay. So if it's a Friday payday, like our FAA or federal employees, they're getting paid on Wednesday night, and they love it. And our risk is the employer going to pay us for the free money we've extended, the pre-payday.
And the risk is super low.
That's like Chime.
The ones we work with, the Whole Foods, UPS, federal agencies, it's not an issue. Small mom and pops, it's a little bit different, but it encourages membership and direct deposit, and we give them an advantage for that. And that's worked out really well. So, they can go shopping on Wednesday instead of when it's all crazy on Friday.
Right. But one thing I would say, Tom, is can you afford not to do it if those members who are going before the demographic was a different demographic. Now, if it's your good people going out to do that and getting hurt, then that impacts their ability to repay you. And that's the calculus I'm trying to sort of figure out that I think makes a difference. But I get your point. I do. And that's exactly what I wanted to hear, because Ben's going to dispel all those beliefs. When you're done, you're going to want to sign. In fact, if you sign the screen, I think Ben will send you I'm pretty sure. Now, I think these are all good points, and I know Ben knows a lot about that because it's a very complex thing. But my fear is that if we don't do something, they're going to go somewhere to get it, and it's not your average people, the people that you normally have the risk with. It's the people that hold the cars and the things that you don't want to lose. It's that percentage of what Jonathan was saying. So without further ado, I'm going to switch it over to Ben. I know Ben very well. He's a very interactive person. I highly recommend that if you have a question, you toss it in chat. We'll stop him. We'll keep an eye on it. But yeah, Ben, let's get into it. So Melissa, if you wouldn't mind moving forward there, and I'll clear my annotations.
All right, maybe just a couple of comments. Thanks for everyone for the conversation. Very, very much appreciated. Always interested in getting credit union feedback around what they're experiencing around this, and absolutely, Jonathan over at Hudson Valley, they're one of our ideal profile clients that really has embraced the product, really leveraged it as a life happens loans, right? So life happens to our members every day, and you don't know what it is, but the need for instant liquidity happens. during branch hours and even after branch hours. So you have to give access. You know, I'll just make a couple comments. One was around, John, when you mentioned, you know, kind of what was going on in 2008. How did we determine, you know, who's going to pay us first person to the reach out to the member was going to get paid? Well, I happened to work in a credit union in Las Vegas. And so we realized that members had like 10 to 20 credit cards because they were giving them all out. And we finally realized that using the data, if we can detect it, then call them first. So the whole entire group was built to that outbound, supporting the member, trying to see how we can help, but ultimately getting paid first. So there are methodologies about using the data that I think are completely valid right now, because what we've done so far is we've created instant liquidity out of the products that we do have, deferring loans, reducing fees, stimulus. So we created member liquidity right now, but that's going to go away. And so then what's going to happen next is the real question. And so, John, I don't know if Melissa ended up getting that presentation that we had, or we just want.
She did. I put a few of the slides in.
Okay, great.
So,
go ahead.
but no, this is the ones that you're right on. I knew you'd handle it.
Yeah. So if we think about what we're trying to do as QCash Financial, is we really were created out of Washington State Employees Credit Union when 17 years ago, we identified that members were using predatory lenders. And when we discovered that, we decided to do something about it and pull them back to the cooperative, save them money, and Tom, to create a sustainable margin. That was important. Let's make no mistake, there is no mission without margin. And we wholly understand that and provide a solution to credit unions so that they can achieve all three. And so we can talk more about that later. But when we started understanding about what the member financial journey was relative to what they understood about managing day-to-day finances, how they were trying to make ends meet, we really knew that the borrow part, or providing instant liquidity, was the foundation, or I would call at the base camp of this journey we're on. But there's more things to do. We have to educate them on how to spend less and save more using both digital ways and in branch ways, and any other way that we can get them to get engaged. But we know this is a journey. And so our company, QCash Financial, is driven to help credit unions increase member financial well-being. Our first stop here is at the borrow stage. And so we've been able to do that. John, if you move to your next slide. So when we take a look at what's happening in America, right? So sometimes we talk about where payday lending is and where it's not. Well, what I'll tell you is that with the banking environment the way it is, online payday lenders can use what they call rent-a-charters from banks that will do that. And in the state of Utah, that's allowed. And so there's a bank called FinWise that supports many, many online payday lenders. So even though you see some of these states without interest rates that aren't allowed legally, members are getting access to that. So do look at the data, even though it might be illegal in your state.
So back to what Tom was saying. So the New Jersey's the bright red here, but so you're saying people there are still getting these kinds of loans through some alternate means that's not being recognized, and those numbers are going to a different state?
Yep, it is.
Okay.
And so we definitely, hold on a second, guys.
Mm-hmm. Can you tell he's actually in the office like you, Tom? That's impressive. Was that Tom calling him just to mess with him? It's a very calming and soothing song. I like it.
Yeah, no, it's my other system. Sorry about that.
Oh,
So
no worries.
anyways, so this is kind of what we see out there. And so in New York, we have as Jonathan talked about, they're supposed to be a very restrictive state, but it still happens there, right? So do look at the data and understand what.
So what does 662% in Texas mean?
So it really depends on how they describe the product, right? So it could be somewhere between, if it's a single pay product, probably about $15 to $20 per 100 is what they're charging. And if it's depending on how long they amortize that, but typically payday lenders are anywhere from 14 days to probably 30 days at the max. Any longer than that, and they can't make a sustainable profit.
So that's the aggregate. What that is the aggregate rate of the predatory lending in that state?
Yep.
Holy crap.
Yeah, it's real.
Yeah.
This happens a lot. So this is kind of the landscape that we see, and really was the reason why WSECU decided to create a QSO and share this technology with the credit union industry, so that they can recapture members and capture market share. So they were able to do that for their members and their markets as well. So next slide.
So warning, the next slide may not be what you think.
No, so this is just an illustration of what we're talking about, right? So we built a solution over 17 years, began in paper, began pulling a credit score. So if we fast forward to today, it's a fully integrated solution, able to be integrated to any channel, fully brandable, multi-language, Spanish, English, using APIs or SSOs, whatever. But the real meat of this is that we're able to deliver a fully funded loan, from origination all the way to funding to the checking account in 6 clicks and 60 seconds. And we don't pull a credit score. So one of the things that we definitely knew is we had to pull out all of the costs in the solution to be able to make it affordable and achieve that triple bottom line that we were looking for, member mission margin. And so that to do that, we got good at data. We understand the predictors of repayment and how to manage that risk so that you can achieve a sustainable margin. And so we don't pull a credit report. So it's about a relationship-based underwriting engine for current members, right? And so we leverage that and continuing to improve that as we bring on more clients so that it gets smarter and smarter. So leveraging the data to be able to underwrite and produce loans. So today, our largest client is probably in volume does about 3,000 loans a month and about $38 million a year in producing value for members based on their relationship and loyalty. And so this is what we look to do to serve in the credit union industry is how do we create more inclusive products? And this is one that when you take credit score out of it, all of a sudden I get to widen my aperture on the number of members that I can serve and help make ends meet as well.
So Ben, on this, I want to just so Gary, you mentioned you had your emergency loan, and what strikes me about this is the payday lenders, like that picture of that payday loans, like that's the everybody knows from that you can drive over there, I don't know, produce a pay stub and walk out with $600, right? That's like if you're desperate, right? What strikes me about this, and I wanted to ask you, how long does it take to get the emergency loan, from start to finish to get the money into your account?
That's a good question. I don't have any data to back it up, but I would assume that it's within a day.
Okay. See, and I wonder, being honest, I don't know if a day's enough or if day's too long, because what's happening is that because my worry is they need it so desperately that if they go to you and you can't have it in their account that afternoon, they'll start looking the Facebook ads and whatever else. So that's where this has to have some parity, I think, with those types of loans. And that's what I'm worried about is, one of Tom's members, one of your members, who is generally a good member now in a desperate mode, who maybe worked their way out of that desperate mode, but remembers payday lending, and they look up Aspire, they love them, but they go, yeah, we could give you a loan, we could do a signature loan, and oh, by the way, we give you your stuff a little early. Yeah, it doesn't help me, that's already spent. I need something that's going to hold me over because I don't have a job and there ain't another paycheck coming, so it isn't going to get me there early. And do they come to you? Is that a better situation? But even if they come to you and you say, well, no problem, we can get this done for you in 2 or 3 days, that could be the difference between starving or whatever. I just don't know. I'm just trying to figure it out, but and look for solutions that, if a fire's coming, investing in fire engines isn't a bad idea. So I'm just trying to see if that's what this is and if there's opportunity there. So Ben, from your perspective, Have you seen an uptick in your clients on this currently? And what is Washington State doing in the credit union around this, given what you know about your area?
Yeah, so it's interesting. For all of our clients, it's very different and depending on their market. So in the Pacific Northwest, what we're seeing is actually volumes went down for their loan products, and
They all got stimulus checks. No need for a payment.
stimulus checks, loan deferrals, skip of payments, all of that created liquidity for the member for today. And so, but however, that's now changed. So the volumes are going up. And again, I think as similar to what we talked about earlier, is all the stuff that we're doing to support members today was great, but it may be too much too soon, given the journey that they're on, because they're on this journey from relief is what they need to recovery to then stability. That's going to require more products, more services along the way. So I'm afraid that we may have given everything in the rush, and we may not have anything left. And so what we're talking about, whether you call it an emergency loan, a disaster loan, a furlough loan, small dollar short-term credit, access to liquidity is going to be needed through each one of those phases as well. So what we also know is if what is a good predictor of the future is what happened in the past. So if we think about the last recession, that the Federal Reserve out of Chicago, I believe, did a study on what happened with payday lending during the last recession, and they indicated that there was a 60% increase in usage. And I'm like, boy, that's a pattern that's going to happen. And all of this work that we've done to support members in this moment could be unraveled as unemployment ends and they move to these predatory lenders. That is the fear that I have.
Well, that's definitely, obviously where I'm coming from. So from the idea that, if you were able to market this is back to Jonathan just for a second, if he's still here, I think he is.
Yep.
Jonathan, if you were to, is there any thought in your organization on reaching out to members who you think will be in peril soon and saying, hey, don't forget we have this?
Yeah, I don't know that we've specifically considered that, but it's certainly an interesting thought and one that I'll bring up to both our marketing and BI team. I think there's a lot of opportunity for this right now. It's honestly probably more relevant across a broad spectrum of our membership than it ever has been, just based on the economic situation we're in. So it's certainly something that I'll be bringing up to those two teams after the call today.
Yeah, it just seems like this would be valuable because that $800 loan or that $1,000 loan could be the difference between bridging the time for you to get another job or changing over what you're doing or whatever and making the payment to Aspire. I'm just going to keep beating on Tom. And, getting, basically that bridge to stability or back to, or even into recovery. But my feeling is that they're going to find it somewhere. It's like water seeking its own level. It's going to happen. They're going to find it somewhere.
Yeah, John, question for Ben. My impression would be by the time people get to the payday loan, that's the lender of last resort. They've really tried and looked at other sources and just haven't found it, is my impression. It could be, part of it could be, though, embarrassment, where they're not going to more legitimate lenders, if you will, or market rate lenders. But when they get to here, they need it now. They need, like, to your point, John, they want to put food on the table. They need a new water heater. These are issues, problems that need to get solved now, not when I can get them the signature loan,
right,
or the overdraft protection on the checking account tomorrow or next week with checks and things like that. I mean, we do loans in 40, 45 minutes, but it's underwritten and it's a process. And again,
there's only so much capacity for that.
Yeah, and right. Maybe we all need RPA in place to help us out here.
Wouldn't hurt. I'm down for RPA.
But that would be my expectation.
But the question to Ben was lender of last resort, and how do you deal with that?
Yeah, how does this flow in there? Is my thesis correct?
It is there. It is not the lender of last choice. What ends up happening is is they become the lender of first choice. So what we end up creating is, because you're right, for some reason we kick members out because either they abused a credit card, which is a complex tool for someone that's not really engaged and aware in managing their day-to-day finances. So I think a credit card that we do does a disservice for a segment of our members. But that happens. And then what happens is they're embarrassed to come back. And so they go to the predatory lender, they walk in and they get this loan, a wonderful experience. And if you haven't done it, I encourage you to do it, because it is a fact. It is a good experience, and it's quick. And so what ends up
Not your
happening,
experience. You're talking about the predatory people.
yeah, the predatory people. Absolutely.
Yeah.
It's an
Yeah, because
awesome
they bring you food, and it's like that place
Call you
where
by
Kevin gets his
name.
haircuts.
Oh yeah, it's
Yeah.
they
There's
understand, they
beer
know your
and all
family.
kinds of stuff. Yeah.
So they make it so easy and convenient and enjoyable that you continue to go back. So you end up creating this underbanked member, because they come to you for the deposit, because you've got to have a checking account to get a payday loan. That's a must. And then they go to the payday lender for their loans, because they know they're going to get it every time. There's no question, no judgment. What it does when you do it online, the way that we've integrated it, it's still a level of anonymity. And so people will come back and they'll try it. So once they get one, then they'll come back for more. And so, and it usually takes around 3 to 4 loans a year to get someone stability and move them up, is the averages that we've seen. So life doesn't get better with one loan. That's the reality. People need to have the ability, because people work part-time, they're hourly, they work on tips. That reality happens every day. So it
Well,
is.
I think you're kind of both right. I think what Tom was saying is, out of desperation, they finally go to the payday lender. And what you're saying, and so that is that last act. But then once they get there, it becomes their first place to go. It creates a habit.
Yeah. And the one thing I'll throw in here, and Ben's point about the experience with a payday lender, there is a great book out called The Unbanking of America. I would encourage anybody interested in sort of understanding the psychology of this type of payday lending industry and the people that use it and how they use it. It's a good read. It's a pretty quick read. It's worth it, because it's very eye-opening.
Yeah. The author, by the way, just a note on that, the author, Lisa Servon, is running a Filene chair of one of their programs, and she's awesome. I can just tell you that. So it is a good book, and she's very intelligent in this area.
Well, so next question for me, Tom, notwithstanding, I love your questions. But do you have any more? Because I was going to ask him about time to implement, because that's the other thing. I feel like, okay, what's that?
You can run the show.
No, I love having you. You know that. But Ben, so, Jonathan, how long does it take to, because given that we know a fire is coming, it's not helpful if the fire engines show up, after the place is burnt down. So my question is like, how hard is it to implement? Is this a year-long project? Is it I'm going to let Jonathan go first. You better hope he had a great experience, Ben, because now you know. And you can look in my screen, he's down, so you can look down. I'm on like the Brady Bunch, but go ahead, Jonathan.
Yeah,
tell
no,
us.
I would say that
you had to threaten Ben twice.
Yeah. So no, honestly, the implementation was the process was great from the QCash side. Honestly, I think our experience was that it took us longer internally to sort of figure out to tweak all of the different parameters to get it just right, where we had our decisioning matrix set up the way we wanted to, because as Ben alluded to, and it's on the screen here as well, there's no credit report. So it took us a while to come up with the business rules that we wanted, to make sure that we had our risks sort of dialed in with where we wanted it at. But as long as you can get your internet banking or online banking provider to play ball with the SSO, we use Alchemy. Prior to Alchemy, we used Digital Insight. Both of them, I think, have pre-built integrations at this point. So, if you can get your business logic, your rules sort of all in a row quickly, and you have a buy-in from your internet or digital banking provider, it's just it's a matter of weeks to get it up and running. It's quick, and being a Scimitar client, QCash certainly knew our core very well. Washington State Educators is a Scimitar core, so we felt like we had a really good relationship there. They knew who we were, they knew what we needed, they knew our technology set, and it was a quick process. Again, the hardest part for us was coming up with the business rules to dial in our risk, our risk level in terms of where we wanted to be and how we wanted to lend the money.
Interesting. So Ben, is Jonathan lying, or is he telling the truth? Because I saw you just email something. I'm not sure what it said. His tone suddenly changed. I'm pretty sure it was like a $50 spiff, or all you have to do is send like a couple Raspberry Pis, and he'll say whatever you want.
Yeah, no, I appreciate that, Jonathan. And it is, and he's right. Where it gets complex is as you want to adapt the underwriting engine to really be in tune with what you want to do. And so that's the point I'll make is we help you manage your program and guide you all the way and meet with you quarterly to make sure you're getting your goals. But ultimately, the implementation is part of our support process, and we try to make it easy. And so right now, what we're doing is we the board of directors at QCash Financial said, what is the way that we can get the most people, the most credit unions implemented on the platform for free. And so they challenged us to come with that because we see the storm coming, John, and they're like, boy, this is going to unravel a lot of things. And so we developed a COVID-19 program for existing cores that we integrate with and existing third parties to say, if we can create an out-of-the-box solution, can we get it implemented in 5 weeks? We absolutely, and make it the lowest barrier for credit unions to get in so they don't have to think about it, and they can get out at the end of 2020 if they'd like. So
you're willing to pay Tom to take the product. That's his kind of deal. I said you're willing to pay Tom to take the product. That's his kind of deal.
Oh, I guess I will sign up on the screen.
No, I think, and I don't want to make this too much of a pitch, but what I am trying to do is bring things to the table that, this or something like it. Like, I think that we've got to use this downtime very, very productively. It's like we see this, we know the tsunami's going to roll in, and we've got to prepare. And so if this isn't, and I like that your board is thinking that way, you and I had that discussion. But yeah, it's just, what else is out there that's like this that could help? It feels like, and it's interesting because one of the other things you got to do, I think, is review your digital inventory to look for opportunities across the board of, okay, if I look at this through a different lens, regardless of whether it's payday lending, emergency loans, all of the things, they had a purpose before. Do they have a new purpose in this new normal? Or is their purpose now, has it been deprecated? Is it no longer useful in the new space? And that's going to be a difficult exercise, but an important one. Like I said, Tom, you mentioned I love the Chime thing that you're doing, where you're giving the money ahead of time. That is a fantastic deal. But again, helpful for some, not helpful if the FAA starts to lay off people.
Yeah, I mean, it's a really one and done because we've just shifted their payday from Friday to Wednesday.
Yeah, it's done and you're good. Yeah.
You're getting it in advance, but you're still every week or every 2 weeks on that different day instead of the original day.
Yeah, it just hit the warehouse and you said, let's release it early.
Right.
That's great. But the people who you mentioned who are looking to put food on the table, who are not getting a paycheck, that's the difference. And so, that combined with a couple other things. So anyways, Ben and I were talking about other things, his Backbase implementation, which was going very well. And they just put out, a lot of people got caught, like Jonathan and Ben, in the middle of a digital sort of transition, and this hit. It's kind of like you were, working on the boat and the storm hit. And so, Ben was, I were talking about that a little bit. But before we go, I want to focus in on this. Those are great questions. Kevin, did you have any thoughts on this in regards? Nope, he's going to shake his head. He says, nope, I got nothing for this. It does have Kobe. I found out that that shirt behind him is Kobe's high school shirt. So apparently he was able to break into Kobe's house and get his high school shirt. So that's great. But a very cool memorabilia there. So anybody else have anything to add to the order or a question for Ben? And we'll be back next week.
John,
Here we go. How many payday loans can a member get? Oh, I'm sorry, Tom, go ahead.
I have one question for Ben. I wanted to pick up, if you could pick up on a point he was making before. You know, one of the problems with the payday lenders is that it's a vicious cycle. Once you get into it, you're just like down and down because you can't afford to pay it, so you borrow more. You can't afford to pay that, you borrow more. But you mentioned how it takes a year within the QCash program to get people to a better place where they're not relying on that. Can you talk a little bit, real high level, on that process and how that works? And I was surprised when you said a year. That to me was a long time, but so I'd be curious to see what the situation you're seeing, and then how are you elevating people to get out of that? Because philosophically, from our board's perspective, they're going to want to know, like, how do we make members better and what's it take? And having a realistic expectation of that would be very helpful.
Yeah, great question. And it is a journey for members, right? Because stability doesn't come just because you get a loan. So it is about being there for them. But this idea of how do you get them out of the cycle eventually happens because you have to work on the other pillars. So we're very much an advocate and a partner with the Financial Health Network, and are working with their research to apply that to solutions we're building. So our clients had come to us early on and said, hey, you're solving the loan part, which is the hardest part, by the way, of getting to financial health and improving financial health. But what's next? What do I do with my people that I'm declining? What do I do when I need to move someone on and upstream? How do I solve those things? And so that's where we're building product to do that. So right now, for denied loans, we're working on being able to push those to the financial counseling services of the credit unions that they have, to be able to begin to work with them, that people that are getting denied for these automatic loans that can happen, and to help try to support them at that point. And then they've gotten some loans. So how do I build more capacity, stability, and resilience in them? And so that doesn't happen overnight as well. So what we've started on is building a new product. It's our financial wellness coach, and it's integrated into the core really, and using the QCash engine to be able to pull in data about their cash flow, their fees that they're seeing, and be able to queue up financial curriculum relevant to the situation that they're in. And we're able to alert them relative when something is going wrong, when we see they're going to have an overdraft, so that we can start to reduce the number of fees they're incurring. Again, trying to create cash flow. At the end of the day, if we can create cash flow, start to build emergency savings, members will make themselves out of this. Now, this is just in pilot right now. So it's taken us a number of years to realize that we've got to get to this next solution that your board is asking. And it really is about those other parts of the pillar of getting them upstream. And so that's in pilot today. And we're always looking for more credit unions to help pilot that solution.
So I've got a hard stop at 2 my time, but how many payday loans can a member get?
It's completely configurable to the credit union. They can configure rates, terms, fees, number of loans, the underwriting, everything in the platform, the UI, the text, the languages is completely configurable to the client and their market. It's up to you.
Albert asks, can the loan be done through a QR code scanned in an employee group ATM?
Hey, interesting. I like that. It could be. Again, there's no manual really input. You're just acknowledging the UI. So literally, I think we could do something there. Give us a call. Let's work that out.
Yeah. So to close this out, thank you, Ben, for joining us. I wanted to just share somebody in the industry that's doing something. I see this coming. I think we'll talk more about it. I also wanted to let you know, just one more repeat. Anybody that's interested, one thing we talked about last week, Ben, and you may be interested in this too, was we were putting together a data group with Doug from Cousins to talk about like for instance, here where I'm at, there's a King Soopers down the street that has had 4 infections and it's been in the news. Well, theoretically, we could go through our data and find every member that went through that King Soopers in the last 2 weeks and let them know. And so we were talking about some services like that to help people out, and kind of came up with kind of a data group. I know Gary's wants to be in it. We've got CJ from out in your neck of the woods. Andrew was interested. There's a few people. So if anybody's still interested in that, Melissa's getting that together. So now's the time. Email us. Gonna try to have a meeting next week to talk about it a little bit. And
Cool, yeah.
Kevin's coming, so you should be excited about that.
Awesome. Well, thanks,
Awesome. Well, listen, thanks everybody. This will be posted. Obviously, if you want to talk to Ben, reach out to him. You can email me. You can go to the QQH website, whatever you need. I'll get messages to him. Ben, thank you for taking the time to go over this, because it's really important we understand sort of the mindset of the folks. I think, to Tom's point, but I also think it's important to understand that mindset may shift on us, and that we're in a world now where, as much as I'd like to look at past behavior, I worry that some of our near past behavior isn't a good predictor given what's going forward,
Yep.
I think it is in the recession cycle of it, but I worry about sort of, the usual metrics that we look at.
Good point, John.
Good stuff.
All right, man. Well, thank you, everyone.
Thanks, everybody.
Thank you.
Thanks, John.
All right,
See ya.
take care.
Bye.